Advanced Audit and Assurance, Chapter 13. Internal Audit and Outsourcing. Content. 1. The nature and development of internal auditing. 2. Types of internal audit. 3. Outsourcing. 4. Chapter Review. Introduction. Competencies. Planning and undertaking work. Reliance on internal audit specialists and the work of other auditors. Exam context. This short chapter deals with two discrete topics, internal audit and outsourcing. You will learn about the type of work that an internal audit department typically performs and the reports they typically produce. The chapter also articulates the difference between internal and external audit. This chapter also looks at outsourcing, what it is and how it works, as well as its advantages and disadvantages. You will see how a client outsourced operations impact the audit and the subsequent audit approach that should be adopted in accordance with ISA 402. By the end of this chapter, students will be able to 1. Describe the functions of internal audit and differentiate between internal and external audit. 2. Explain the difference between financial, operational, and compliance audit. 3. Discuss which functions may be outsourced and the relative advantages and disadvantages of outsourcing. 4. Explain the audit considerations per ISA 402 relating to entities using service organizations and the nature of Type 1 and Type 2 reports as included in ISAE 3402. Subtopic 1. The nature and development of internal auditing. Section Overview. Section 1. Definition of internal audit. Section 2. Reasons for the development of internal auditing. Section 3. Typical functions of internal audit. Section 4. Comparison of external and internal audit. Section 1.1. Definition of internal audit. The role of the internal audit function has been defined as an appraisal system established by management for the review of the accounting and internal control systems as a service to the entity. There are several parts to this definition. 1. Internal auditing is an appraisal system. 2. It is established by management as a service to the entity. 3. It involves the review of accounting system. 4. It also involves the review of internal control systems, which are systems for financial controls, operational controls, and compliance controls. Internal auditing is a separate and distinct branch of the accounting profession. The role of internal auditing has become more significant in larger entities and is now seen as an important management tool. Section 1.2. Reasons for the development of internal auditing. The main reasons for the importance of the internal audit function are as follows. 1. Internal audit helps management to monitor the controls within their entity. As entities increase in size and complexity and become global in nature, the task of monitoring controls become more difficult. An internal audit function helps management to monitor these controls. 2. Similarly, as markets become increasingly competitive, it is important that entities should be very competitive themselves. This means using resources efficiently and effectively. An internal audit function can be used to monitor the efficiency of operations. 3. In many countries, there is a large amount of statutory and accounting regulations, including corporate governance regulation. An internal audit function can be used by management to check on compliance with laws and regulations. 4. Many entities use complex IT systems. Specialist internal auditors can help management to review the effectiveness of controls within IT systems by means of IT audits. 5. The increasing cost of the external auditor services means that it may be cheaper to use internal auditors to perform audit tasks whenever possible. The reliance of external auditors on work done by internal auditor is considered later. However, an internal audit department may be used for work not related to the external audit that might otherwise be given to an external firm of accountants as non-audit work. There is a legal requirement for an entity to establish an internal audit function. The fact that many organizations do so indicates that there are significant benefits to be gained. For companies that operate over multiple sites, internal audit may be an essential tool for effective management. Senior management can use an internal audit department to carry out external checks on its operational department. Random visits or surprise visits by internal auditors may be used to confirm that all locations are applying internal controls properly and are complying with relevant laws and regulations. The largest locations or locations where there is a high risk of control failure may be visited more frequently by the internal auditors. Section 1.3. Typical functions of internal audit. The scope and objectives of internal audit vary widely and depend on 1. The size and structure of the entity, and 2. The requirements of its management. However, internal audit activities usually include one or more of the following. 1. Monitoring of internal control. Senior management need to reassure themselves that internal controls are functioning effectively. In a large organization, they do not have the time to carry out this task personally. For example, through observation, monitoring controls and making sure that the controls are working properly needs attention on a continuous basis. An internal audit department is usually given the specific responsibility by management for reviewing controls, monitoring their operation, and recommending improvements. Examination of financial and operating information. Examination of financial and operating information. An internal audit department might be given the responsibility for a detailed examination of financial and operating information, and in particular its reliability and usefulness. Internal auditors may investigate how information is identified, measured, classified, and reported, and recommend improvement where appropriate. The audit work may involve investigations into specific items of information, including the detailed testing of transactions, balances, and procedures. Review of the economy, efficiency, and effectiveness of operations. That's point 3. Review of the economy, efficiency, and effectiveness of operations, including non-financial controls of an entity. Audits of economy, efficiency, and effectiveness can be carried out on any aspect of operations and are usually called value for money VFM audits. 4. Review of compliance. Senior management may ask the internal auditor to check that operational departments are complying properly with certain laws, regulations, and other external requirements, or with management policies and directives and other internal requirements. These investigations are often called compliance audits. Section 1.4. Comparison of external and internal audits. Internal and external auditors will often carry out their work using similar procedures. However, there are a number of fundamental differences between the two audit rules. These are summarized in the following table. we have 3 columns: factor, external audit, internal audit. So factor, role. The external audit role is to express an opinion on the truth and fairness of the annual financial statement, while the role of the internal audit is to examine systems and controls and assess risk in order to make recommendations to management for improvement. Qualification to act. The qualification to act of external audit is set out by statute. The qualification to act for internal audit is no statutory requirement. Management select a suitable competent person. The external audit is appointed by the shareholders. Internal auditor is appointed by the management. The duties set out by external audit. The duties are set out by statute for external audit. Duties set out for internal audit are by management. The external auditor reports to the shareholders, while the internal auditor reports to management. Subtopic 2. Types of internal audit. Section overview. 1. Introduction. 2. Financial audit. 3. Operational audit. 4. Compliance audit. Section 2.1. Introduction. Internal auditors may be involved in financial audit, focusing on the audit of items in the income statement or statement of comprehensive income and statement of financial position. When the internal auditors perform this type of work, they may duplicate work that the external auditors might otherwise be expected to do. The external auditors might therefore be able to rely on the work of the internal auditor in reaching their audit conclusion. This was considered in Chapter 8. However, the internal audit function often has a much wider role than simply performing financial audits, and in many entities, particularly large entities, the internal auditors are involved in other aspects of auditing, such as 1. Energy audits. These are checks on how the entity is making use of energy and whether its operations are energy efficient. 2. Social audits. These are checks on the impact of the entity on the society in which it operates. 3. Environmental audit. These are checks on the effect the entity is having on its natural environment and considers issues such as the use of sustainable materials, recycling, reducing pollution, and so on. 4. Human resource audits. These are audits to the workforce of an entity. These are audits into the workforce of an entity to check whether the entity has adequate system for the recruitment, training, and development of employees to meet its current and future needs. Section 2.2. Financial audit. Performing financial audits is the traditional role of the internal auditor. Internal auditors may be asked by management to review accounting records and other records to substantiate figures appearing in the financial statements and management accounts. This work overlaps with the work of the external auditors. Consequently, this aspect of internal audit work is now seen as relatively minor part of the total work of an internal audit department. However, it is important to remember that by performing financial audit, the internal auditor is able to look at the internal controls that are in place to minimize risk, to identify weaknesses, and to recommend improvement in the internal control system. Section 2.3. Operational audit. Operational audits examine the entity's internal control procedures and whether or not the control systems that have been established by management are operating effectively. As a result of the audit, the internal audit department will make recommendations to the management for improvements to the system or the way in which it is operated. The value for money audit was described in an earlier chapter as an assurance service that might be performed for a client by an external accountancy firm. VFM audits may be carried out instead by the internal audit department. Finding the best possible combination of the three is seen as a strategy for maximizing profit performance. It is not usually possible to achieve objectives effectiveness by using the cheapest resources, economy in the most productive way possible, efficiency. Sometimes, greater efficiency can only be achieved by spending more, or a balance must be found between economy and efficiency. Sometimes, the benefits of greater effectiveness are not justified by the extra cost, so a balance must be found between economy and effectiveness. One of the purposes of a VFM audit should be to check whether the most appropriate balance between economy, efficiency, and effectiveness is being achieved. Section 2.4 Compliance Audit. Entities are subject to a large number of laws and regulations, and they may be exposed to the risk of regulatory action by the authorities if they fail to comply with the regulations. The nature of important regulations vary from one industry to another. Controls over health and hygiene are important for the food manufacturing industry. For example, controls over population are important for companies involved in oil and gas exploration. Controls over money laundering are important for financial services, and controls over safety are important for companies in the public transport industry. Internal audits can be used by management as a tool to confirm that significant laws and regulations are being complied with by the company or other reporting entity. Subtopic 3. Outsourcing. Section Overview. 1. Financial operations that might be outsourced. 2. Advantages and disadvantages of outsourcing. 3. Outsourcing the internal audit functions. 4. Outsourcing other finance or accounting functions. 5. ISA 402. Audit considerations relating to entities using service organizations. 6. ISAE 3402. Assurance report on controls at a service organization. Section 3.1. Financial operations that might be outsourced. Definition: outsourcing. Outsourcing by a company means arranging for an external entity to perform a task that would otherwise be performed by the company's own staff. It usually refers to routine and repetitive procedures and operations. Outsourcing of work to external suppliers and service organizations is a common practice. Examples of work that may be outsourced include 1. Payroll operations. 2. Internal auditing. 3. Financial and management accounting activities, for example, data processing or pensions. 4. IT services. 5. Work relating to taxation compliance and tax consultancy. 6. Due diligence procedures for acquisition and mergers. 7. Non-financial services such as catering, cleaning, motor vehicle fleet management, and staff recruitment and selection. Entire functions may be outsourced. For example, an entity may outsource all the financial accounting functions from bookkeeping through to the preparation of final financial statements. Alternatively, only part of functions may be outsourced, with the remainder of the function being retained in-house. For example, an entity may outsource its payroll function, but perform the rest of the accounting and finance function itself. A problem for the auditors, internal and external, is that when work is outsourced, they need to satisfy themselves that the external agencies are performing their work properly. It may be necessary to check that the information provided by the external agency is correct and not subject to misstatement, and that the internal controls applied by these external agencies are effective. Section 3.2. Advantages and disadvantages of outsourcing. Advantages. There are several reasons why entities outsource their operations. 1. Cost savings. It may be cheaper to outsource work to an external service provider than to do the work in-house. 2. The skills of the external agency or service provider. An external service provider may have skills and expertise for doing the work that the entity itself does not have in-house. 3. Access to the most up-to-date techniques and technology might not be readily available within the entity, but the external agency may have them. 4. The management of the entity are able to focus their time and effort on the core activities and do not have to spend as much time monitoring the outsourced activities. Disadvantages. There are also disadvantages with outsourcing. 1. The management of the entity needs to make sure that the service provider understands the requirements of the entity in respect of the service that it is providing. If the work is not properly specified, the service provider may fail to do everything that the entity requires it to do. 2. The entity relies on the service provider to do its work on time and have it ready at the time that the entity requires it. This is particularly important, for example, when payroll operations are outsourced. 3. There may be problems with negotiating an appropriate fee for the work with the service provider. 4. Management need to ensure that the service provider gives the organization an appropriate level of priority and customer care. This means that management must carry out regular review of the service level and service quality provided. In general, the outsourcing arrangement needs to be effectively managed and controlled by the organization. Section 3.3. Outsourcing the internal audit functions. Some entities outsource the work of the internal audit function. When this happens, the service provider is often the accountancy firm that provides the entity with its external audit services. Several factors need to be considered when an entity outsources any of its internal audit function. 1. The accounting firm must have a greater level of independence than the entity's own internal audit staff. If the external audit firm is not properly independent from the executive management of the entity, it should not be given any internal audit work. 2. The accounting firm may have access to more highly trained specialist employees. 3. The accounting firm will have greater numbers of employees available for any urgent internal audit assignments. 4. Professional codes of conduct and standards of behavior will regulate the accounting firm. This might not be the case with an in-house internal audit department. 5. The accounting firm may be sued for breach of contract or for negligent work, and should have professional indemnity insurance to meet claims for losses due to negligent work. However, there are a number of disadvantages with outsourcing the internal audit function to the external accounting firm. Professional firms are not under the control of the entity in the same way as their in-house internal audit employees. 2. Fees for internal audit work can be high. 3. Professional firms may not have the same level of detailed knowledge of the entity and its operation that in-house internal auditors working in the organization on a daily basis should have. 4. There may be threats to the independence of the external auditor where the firm acts as both internal audit and external auditor. Section 3.4. Outsourcing other finance or accounting functions. A list of examples of other functions that could be outsourced was given at the start of this section. In the exam, you may be required to comment on the specific advantages and disadvantages of outsourcing any of these. An important aspect of outsourcing accounting functions may be that the external supplier controls the accounting records from which figures for the financial statements are obtained. For example, if payroll work is outsourced, the data for employee costs and any liability for payroll, such as tax liability, may be held by the service provider, not by the audit client. The audit client may hold none of this information. The auditor is engaged by the audit client and has no contractual relationship with the service organization. However, the auditor may need to obtain audit evidence from the service organization. Clearly, it is impossible that if the service organization controls any accounting information for the audit client, the contractual arrangement between the audit client and the service organization should include an obligation for the service organization to provide the auditor with access to the information required. Issues for the auditor to consider in this type of situation are as follows. 1. Materiality. The auditor should decide whether the outsourced operation is material in terms of the financial statement. If payroll work is outsourced, this is likely to be a material item and the auditor will have to consider how to obtain sufficient, appropriate evidence about payroll costs. 2. Accessibility to the records. This point was considered earlier. It is important that access to the relevant records is available for the auditor, and the auditor should discuss with the service organization the arrangement for obtaining the information required. 3. Control risk. The auditor will need to make an assessment of control risk in the outsourced operations. A system audit will be possible if the auditor is satisfied with the control system in the service organization. Otherwise, substantive auditing procedures will be needed. 4. Compliance. Where the outsourced work is subject to regulatory requirements, the auditor will need to consider how to gather evidence about compliance with the regulations. An example is the need to check compliance with tax regulations for deductions from tax. In the case of outsourced payroll activities. 5. Transfer of information. It may also be necessary to check the procedures for the transfer of information between the service organization and the audit client. To establish how information is transferred, how often it is transferred, and whether the method of transfer is reliable. If you are asked in an exam question to comment on outsourcing any function, remember to think specifically about the relevant function you are being asked about, and think through factors such as 1. The logistics or practical issues of the outsourced operation. 2. The confidentiality associated with the source information. For example, in respect of payroll, pension details are considered highly confidential by staff. 3. The speed of technological advancement in the area. 4. The responsibility for the function. For example, directors will still be legally responsible to ensure that proper accounting records are kept even if they outsource them. Section 3.5 ISA 402 Audit considerations relating to an entity using a service organization. ISA 402 provides guidance to external auditors where clients outsource some of their operations to service organization. The services provided by a service organization are relevant to the audit when those services and the controls over them are part of the entity's information system. Such controls are most likely to relate to financial reporting, but other controls could also be relevant to the audit, such as controls over the safeguarding of assets. When the client uses the services of a service organization, the objectives of the auditor per ISA 402 are 1. To obtain an understanding of the nature and significance of those services and their effect on his client's internal controls, sufficient to identify and assess the risk of material misstatement, and 2. To design and perform audit procedures in response to the assessed risk. Obtaining an understanding of the services provided. In obtaining an understanding of the services provided, the auditor is applying ISA 315, which was discussed in a previous chapter. The auditor is required to 1. Understand how his client uses the services provided, and 2. Evaluate the controls at his client which relate to the services provided. For example, a client may have outsourced its payroll transactions and have established controls over the submission and receipt of payroll information that would prevent or detect material misstatement. Testing these controls may enable the auditor to conclude that payroll is not materially misstated, regardless of the controls in place at the service organization. If the auditor is unable to obtain a sufficient understanding from the client, then he should use one or more of the following procedures. 1. Obtain a Type 1 or Type 2 report. 2. Contact the service organization via the client to obtain specific information. 3. Visit the service organization and perform appropriate procedures to give the necessary information. 4. Use another auditor to perform such procedures. Type 1 and Type 2 report. A Type 1 report comprises 1. A description of the service organization's system, control objectives, and controls as a specified at a specified date, prepared by the management of the service organization. And 2. A reasonable assurance report on the above description and the suitability of the controls to achieve the specified control objectives, prepared by an auditor instructed by the service organization. A Type 2 report is a more detailed report, covering not only the theoretical controls in place, but also whether in practice the controls have achieved their objectives. The description may now cover a specified period and may also report on the operating effectiveness of the controls over that period. The report will now also give 1. The service auditor's opinion in the operating effectiveness of the controls, and 2. A description and the result of his test of controls. In response to the recent trend of an increase in the use of service organizations, a new international standard on assurance engagement, ISAE 3402, assurance report on controls as a service organization has been issued. This is effective for periods ending on or after June 15, 2011. In common with earlier theory in this chapter, before relying on the Type 1 or Type 2 reports, the user auditor must be satisfied as to 1. The service auditor's professional competence and independence from the service organization, and 2. The standards under which the report was issued. Reporting to the assessed risk of material misstatement. Responding to the assessed risk of material misstatement. In responding to the assessed risk, the auditor is applying ISA 330, which was discussed in previous chapter. The auditor is required to 1. Determine whether sufficient appropriate audit evidence is available from records held at the client, and if not, perform further audit procedures to obtain such evidence of use. Perform further audit procedure to obtain such evidence, or use another auditor to perform those procedures at the service organization on his behalf. If the auditor wishes to perform test of controls, he should use one or more of the following procedures. 1. Obtain a Type 2 report. 2. Perform appropriate test of controls at the service organization. 3. Use another auditor to perform such procedures on his behalf. Other requirements. The auditor should inquire of management as to whether the service organization has reported any fraud, non-compliance, or uncorrected misstatements to them. If the auditor is unable to obtain sufficient appropriate audit evidence regarding the services provided by the service organization, he should express a modified opinion in his audit report. The auditor should not refer in his reports to the work of a service auditor unless that is required by law or regulation. Even then, or if the auditor refers to the expert work in his report because it is relevant to an understanding of the modified opinion, then he must make it clear that such a reference does not reduce his responsibility for that opinion in any way. Section 3.6, International Standard on Assurance Engagement 3402. Assurance reports on controls at a service organization. ISAE 3402 deals with assurance engagement undertaken by a professional accountant in public practice to provide a report for use by user entities, that is the audit client, and their auditors on the controls at a service organization that provides a service to user entities that is likely to be relevant to user entities. Internal user entities internal control as it relates to financial reporting. ISAE 3402 complements ISA 402 in that reports prepared in accordance with ISAE 3402 are capable of providing appropriate evidence under ISA 402. ISAE 3402 states that the objectives of the service auditor are 1. To obtain reasonable assurance about whether in all material respects based on suitable criteria the service organization's description of its system fairly presents the system as designed and implemented through the specified period. 2. The controls related to the control objectives stated in the service organization's description of its system were suitably designed throughout the specified period. 3. Were included in the scope of the management. 3. Were included in the scope of the engagement. The controls operated effectively to provide reasonable assurance that the control objectives stated in the service organization's description of its system were achieved through the specified period. To report on the matters in A above in accordance with the service auditor's finding. Illustrative opinion for a Type 1 report. Opinion. Our opinion has been formed on the basis of the matters outlined in this report. The criteria we used in forming our opinion are those described at page AA. In our opinion, in all material respects, A, the description fairly presents the system as designed and implemented as at date, and B, the controls related to the control objectives stated in description were suitably designed as at date. Illustrative opinion for a Type 2 report. Opinion. Our opinion has been formed on the basis of the matters outlined in this report. The criteria we used in forming our opinion are those described at page AA. In our opinion, in all material respects, A, the description fairly presents the type or name of system as designed and implemented throughout the period from date to date. B, the controls related to the control objectives stated in the description were suitably designed throughout the period from date to date. And C, the controls tested, which were those necessary to provide reasonable assurance that the control objectives stated in the description were achieved, operated effectively throughout the period from date to date. Description of test of controls. The specific controls tested and the nature, timing, and result of those tests are listed on page YY to ZZ. Subtopic 4, Chapter Review. Chapter Review. Before moving on to the next chapter, check that you now know how to 1. Describe the functions of internal audit and differentiate between internal and external audit. 2. Explain the difference between financial, operational, and compliance audits. 3. Discuss which functions may be outsourced and the relative advantages and disadvantages of outsourcing. 4. Explain the audit considerations per ISA 402 relating to entities using service organization and the nature of Type 1 and Type 2 reports as included in ISAE 3402. Quick quiz questions. 1. Internal audit may be outsourced. Which one of the following does not represent an advantage of outsourcing compared with keeping the audit work in-house? 1. Greater independence of the auditor. 2. Better knowledge. 3. Lower cost. Option A, 1 and 2 only. B, 1 and 3 only. C, 2 and 3 only. D, 1, 2 and 3. Answer is C. Employees would be more likely to have an intimate knowledge of the particular business than brought in external specialists. Question 2. Which of the following is not true about internal audit? 1. Internal audit work may in some circumstances be performed by the external auditor. 2. The audit committee should review the work of internal audit. 3. The external audit must use the work of internal audit. Option A, 1 and 2 only. B, 1 and 3 only. C, 2 and 3 only. D, 1, 2, and 3? The answer is C. The external auditor may use the work of internal audit, but there is no obligation. The audit committee should review the effectiveness of internal audit, but will not review internal audit assignments in details, since the committee members lack the expertise or time to do this. Question 3. Which of the following criteria should the external auditor consider when performing a risk assessment of the internal audit function? 1. Organizational status of internal audit within the entity. 2. Technical competence of internal audit. 3. Size of the internal audit department. Options: A. 1 and 2 only. B. 1 and 3 only. C. 2 and 3 only. D. 1, 2, and 3. The answer is D. A risk assessment of internal audit is concerned with the risk that the internal auditors might not provide independent and reliable opinions on the subject matter of their audit. The organizational status of the head of internal audit may affect the independence of the department. Technical competence affects the quality of the work performed. The size of the department may also be relevant because the department might not have enough staff to handle all the work that is required to do. Question 4. The usual aim of a VFM audit is to A. Check whether more spending is necessary to improve economy, efficiency, and effectiveness. B. Set realistic targets for economy, efficiency, and effectiveness. C. Check whether a suitable balance exists between economy, efficiency, and effectiveness. D. Check whether economy, efficiency, and effectiveness are all being maximized. The answer is C. It is rarely possible to maximize all three of the three E's: economy, efficiency, and effectiveness. And a VFM audit is much more likely to consider whether a suitable balance between the three is being achieved. Economy means less spending or better spending. Therefore, checking whether more spending is needed to improve economy is a contradiction in terms. Question 5. Which of the following activities may be a function of the internal audit department? 1. Monitoring of internal control. 2. Review of compliance. 3. Preparation of month-end accounts. Options: A. 1 only. B. 1 and 2 only. C. 1 and 3 only. D. 2 and 3 only. Answer: B. Internal auditors carry out audits. They don't prepare sets of accounts. That's the end of chapter 13. Thank you.